Well, we're just over halfway through 2023, and it's certainly not been plain sailing in fixed income markets. I'm your moderator for today, Audrey Simon, and joining me is Assistant Fund Manager at PSG Asset Management, Ané Craig. Ané, can you give us an overview of what's happened in the fixed income markets so far this year?
Sure, Audrey. This year has been all about inflation for fixed income investors, and that's really been a theme that we've seen continue from about June last year, when you started to see high global inflation prints and also central banks across the world respond with higher interest rates. And we really saw, in particular, the Fed and also Europe lift off, if you will, from interest rates just below zero, sort of start midway last year, increasing by 4% last year. And this year we've seen a continuation of that with interest rates and then therefore bond yields another sort of percent higher up. That inflation outlook hasn't been easy. So you've seen that the market has been very responsive around inflation prints, and those would include inflation data themselves, but also growth data like US jobless claims and US jobs prints. As the market is forming expectations around near-term and longer-term inflation, these sort of data points give it an indication of how monetary policy has responded to inflation and what the impact on the economy would be. In essence, are we going to have a hard landing type recession in the US, which would most likely lead to a global recession, or a softer kind of benign, soft landing, a short-lived, shallow kind of recessionary environment? So these things are very important when it comes to bond prices: inflation, the monetary response through interest rates, as well as growth. And that really has been the theme globally. And when we zoom into South Africa, we see that our bond yields has really tracked actually developed market bond yields to a very large extent, including during times of these data prints, and especially when there's been larger swings in inflation expectations, such as when we saw Credit Suisse and Silicon Valley Bank failures at the start of 2023. And that really led to quite a leg higher in bond yields, which of course meant lower prices, and that impact flowed through to emerging market assets such as South African bonds. Now, the only time when we really saw a dislocation in South African bond yields from the global bond yield trend was when the news headlines hit in May that South Africa has been accused of selling arms to Russia. And that was really the only idiosyncratic factor where you saw our bond yields perform slightly differently to the global market kind of context. And that's despite the load shedding we've experienced last year. That really is in the base of 2022. We've already seen that South African credit risk premium increase. And so the theme has been global, and it's been that global macroeconomic focus on inflation and inflation uncertainty that's really driven bond yields globally and locally.
So as a fixed income fund manager, I can see that a key challenge for you must be how to reconcile, needing that stable income for clients with everything that's happening in the market and all that volatility. Can you give us some insights into what the impact of these developments have been for our portfolios?
Sure, so I'll maybe break that down into two parts. First, the impact on the asset classes, and then how we blend that and manage that in the portfolio context. So an environment of higher interest rates and also higher volatility has been good for floating rate assets. So those would be floating rate bonds. We now have floating rate government bonds, but typically that would be floating rate credit issued by corporates and the likes of preference shares. Those have performed really well. And then in the first quarter of 2023, we saw hard currency cash really do well. We saw a very strong dollar and quite a weak rand. You also saw offshore credit perform very well. Inflation-linked bonds locally outperformed fixed-rate bonds locally. And what really underperformed is South African fixed-rate bonds and also local listed property. Now, how we blend that into an income product where we have capital preservation in mind, and our clients are also looking for a slightly smoother journey than the market as a whole would give them. So what we do is focus on the long-term value proposition, but we also mitigate around the edges, if you will, for bouts of periods of short-term volatility and underperformance. Now, volatility gives rise to opportunity, potential for mispricing. So what's been really powerful is cash, and you would have seen our cash and local cash rates increase this year so that we can provide liquidity into market when we see these opportunities arise. We've also sold assets that have performed well and bought assets that have performed less well. And that's in line with a core philosophy that we have of buying assets with what we call a margin of safety. So easier said than done, but simply put, we buy cheap assets and we sell expensive ones. So you would have seen a bit of a rotation from inflation-linked bonds into fixed-rate bonds within our local portfolios. You would have seen us selling some of our hard currency cash, particularly after the first quarter of the year when that performed really well. And you would have seen us very, very gradually build also an offshore credit position. And that again just balances our core view around South African government fixed rate bonds, gives us some diversification, portfolio protection, and also a source of yield that just doesn't have anything to do with South Africa.
So looking forward, what do you anticipate for the rest of the year? Is it going to be a stabler environment, or are we going to see more upsets and gyrations in the market?
So I think there is definitely good potential for higher levels of uncertainty. And again, I'll bring that back to inflation. And so we have a long-term structural view that inflation is going to be higher than it's been in the post-GFC era. Now, certainly not the inflation prints that we've seen 8, 9, 10% in the developed market world, or even in South Africa, but certainly not the 2% that the world has gotten used to post the GFC. And we think that's probably closer to around 3%, which sounds very, very small, but that's of course quite a large delta and can have an enormous impact on asset prices, not just in fixed income, but also in equity markets. And the reason for that is that we've seen a multi-decade underinvestment in key sectors like energy. And that's really been underinvestment in anything considered dirty, such as oil. And we do think that 2022 and 2023 has really just been the start of energy insecurity over the short term. So we do expect a fiscal response, and that could come twofold. We have seen governments such as in the UK provide energy subsidies, and that's quite possible over the short to medium term. But governments are also investing in their own energy security and their own energy supply, which of course means fixed capital investment, which in itself is also quite inflationary. So interestingly, you see policies from governments counteracting the policy from central banks. So fiscal policy has been expansionary and inflationary to some extent, and we expect that to increase, where monetary policy has actually been contractionary or tightening. So what that boils down to is over the short term, central banks will tame inflation, but they're not going to be able to go it alone. And we think that fiscal policy won't support monetary policy in fighting inflation over the medium term because of government's investment in areas like energy, which has had less capital than required for multiple decades. And so because of that, we see inflation, as we said, landing slightly higher than it has been post-GFC. What that means for global bonds and global fixed interest assets is we're not there yet. We don't think there's enough inflation uncertainty premium priced in. So our offshore credit and offshore bond positioning has been very short-dated, short duration, so that you don't have that price impact when bond yields do lift, even though it would seem marginal. In 50 basis points or 100 basis points, the price impact can be quite material. But we have a lot of firepower to be able to buy into those kind of opportunities when they arise. Locally, we've got a different inflation profile. Because we don't have a strong economy and consumers buying goods that are in short supply, we find that inflation has already moderated to within the Reserve Bank's target band, and we also see the Bureau of Economic Research expecting inflation much closer to that 4.5% midpoint of the target band well into 2024. So what that means is locally, softer economy, softer inflation, it's actually a really good environment for government bonds. And that is where we are quite constructive.
Ané, thank you so much for joining us today and sharing your insights about the environment we see ahead for fixed income investors. It's been a really great chat. Thank you so much.
Audrey. Thank you.